Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Scott Nations, President of Nations Indexes, to discuss potential risks to the year-end rally. Scott, it's great to see you as always. Welcome back to Trade Talks. And I thought it was interesting over the past couple of weeks where we saw the VIX a little bit elevated. We saw equities continuing to rally. And even you noticed that there's now a bottom in implied volatility. Does any of this activity suggest there's some complacency in the market?
Oh, I think it suggests that there's quite a bit of complacency in the market. And you're right. We seem to have finally found a bottom in implied volatility, which is the market's best measure of expectations for risk over the next 30 days. We saw on Thursday of last week, a number of volatility indexes found a bottom. Taildex, ticker symbol TDEX, is one example. It's measures the cost of 30-day crash protection. It just collapsed early in the day on Thursday, and then really seemed to find a bottom rally throughout the course of the day. It's always tough to apply technical analysis to option and volatility measures, but Thursday, Taildex put in a key reversal. So we seem to have found a bottom. There are still elements of the volatility market which are very cheap, even though in general volatility seems to have found a bottom in this market. So in both the S&P and in the Nasdaq 100, protective puts, out of the money puts, are still very cheap relative to out of the money calls. So to your point, Jill, plenty of complacency.
I think the move in the 10-year, and even before, the 20 basis points that we saw on Wednesday last week, which is a big move in just one session, but even leading up the few weeks into it, I feel like the move down in the 10-year really did lend to this equity rally here. But it makes you question how much of this was priced in. I feel like the moves over the past 6 to 7 weeks, whether you're looking at the 10-year, whether you're looking at equities or some other asset classes, really are counting on the Fed a lot here.
I agree completely. We had an everything rally over the past, say, 6 weeks. Just if it could go up in price and it was an asset, then it seemed to do so. Largely driven by the hypersensitivity that everything is showing to bond prices and to rates. And you're absolutely right. We got nearly to 5% in the 10-year yield, and now we're just below 4%, a huge move. And, a decline like that in rates makes every asset more attractive, whether it's gold, which I'm not a big fan of, or equities, which I am a big fan of. And then obviously, if rates are going lower, that means bond prices are going higher. You're absolutely right. And so much of that move in the 10-year is due to what the Fed has had to say and what they've done recently.
Have you seen any improvement in breadth? It seems as if we're talking more about small caps and other areas of participation in the market, but I still feel as if the indexes really do, especially the Nasdaq 100, are reliant on what happens with the Mag 7 here.
Yeah, you're absolutely right. Once again, the Nasdaq 100, which includes all of those names, is up more than 53% for the year. The S&P, which is cap weighted, so they're really driving much of that performance, is up 23% year to date. And again, think about it, that those moves in equities have happened despite the increase that we've seen in the 10-year yield since the beginning of the year. Yes, that move in the 10-year has come in quite a bit, but we're still higher than where we started. And so that's really, really impressive. But then if you look like something like the S&P equal weight, which is up less than half of what the cap weighted measure is up for the year, or you look at the Russell 2000, you see that those Magnificent Seven names are really, really driving the market, which is another reason to worry, because we know that investors love to sell their winners and hold their losers, and those Mag 7 names, those are the big winners. And if we have a Fed hiccup, it'd be very easy to think that those are the names that are going to get sold first.
I think, though, however, there are some lessons to be learned here for sure, especially if you're longer term, buy and hold retail investor. Expectations were really low for 2023, and the market certainly dealt a surprise. But I think if you, were to look at very, very long-term charts, and you were talking about this off camera earlier, that slow and steady kind of wins the equity race if you're thinking really long-term investing.
That's absolutely right. And yes, I think equity investors are very pleasantly surprised about what they got this year. Again, we knew that rates were going to have to increase, that the Fed was going to get serious about inflation. And that's generally not a good prescription for equities. And so again, if you look at your portfolio value, you have to be very pleasantly surprised, but don't get too wrapped up in that. I mean, it's so easy to look at at a really wonderful year and fall for recency bias and think it's going to happen again next year and the year after. To the degree that stocks are a random walk, we've had a nice year. Let's celebrate it. And it tells you that you shouldn't be trying to time the market. You should stay invested.
All right, Scott, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Market Reporter at Nasdaq.